Investing mistakes you should stay away from. You're probably aware of certain frequent errors that lead investors astray by this point in your investing career. There are obvious and avoidable pitfalls that can diminish your savings potential or result in excruciating losses, such as overreaching to market volatility, following investing trends, or postponing investing entirely. However, there are also less noticeable mistakes that can prevent you from reaching your financial objectives. According to Nitin Barve, CFA, Director of Portfolio Analysis and Advice Tools and Policy at the Schwab Center for Financial Research, some problems may be behind the hood, making them tougher to diagnose. Others may result from behavioral biases that we all have but frequently are not conscious of, such as misalignment between your values and your real holdings. Or you might be missing out on chances to reduce your tax liability. That's why in today's video we'll talk about these investing mistakes you should probably stay away from. Kicking off with number 1, you are not doing it right if you're being over-concentrated in individual stocks or sectors. Sure, diversification is a good thing when it comes to investing. Individual equities typically exhibit greater volatility than a broad range of stocks. The majority of firms in the Russell 1000 index have produced annual returns that are lower than the index for 8 out of the last 10 years. An average 29% of these companies have seen yearly losses. When the market declines, especially spreading your money throughout a variety of assets can help to ensure that your investments don't move in lockstep. But even for portfolios that begin diversified, overconcentration can grow to be a significant problem over time. You can own stock in a company or industry that has experienced significant growth, making up a growing percentage of your portfolio, especially in a cap-weighted funds that gives more weight to businesses with the largest market capitalization. You can hold the same stock in many funds. People who work for publicly traded corporations can earn stock options or restricted stock units as part of their remuneration, are similarly at risk of overconcentration, particularly if they hold shares of the company through other funds. Number 2, you might also be owning stocks you probably don't want. You can also have equities in your portfolio that you would prefer to refrain from owning. If you believe that specific companies or industries may be negatively impacted by long-term developments like sustainability, artificial intelligence, or mobility, you may want to steer clear of stocks that could be affected. When deciding where to invest, you can be motivated by a personal set of values, such as choosing businesses that have a proven track record of treating their people well or refraining from hurting the environment. You run a higher chance of having a few stocks that don't reflect your beliefs or values if you decide to diversify your portfolio by investing in index funds and actively managed funds that hold a variety of companies. Even when you specifically search for a fund that, at least on the surface, appears to invest where you desire, it might be challenging to find the ideal one. For instance, certain ESG funds, which invest in businesses with high environmental, social, or governance ratings, have exposure to organizations that may perform poorly on environmental measures, but stand out from the competition in terms of social or governance considerations. Since you don't directly own or control the underlying securities, your ability to influence the situation is at best constrained. Number 3, failing to generate tax alpha. Although after-tax profits are ultimately what investors keep, they are generally given less consideration than pre-tax returns. By producing tax alpha, or the amount of outperformance your portfolio may experience as a result of implementing effective tax techniques, tax-saving measures such as tax loss harvesting have the ability to narrow the gap between the two. The following equations can be used to get tax alpha. Tax alpha equals after-tax excess return minus pre-tax excess return. Is that confusing? Well, let's imagine, for illustration purposes, that a conventional managed portfolio achieves a pre-tax return of 11%, matching the benchmark index. There's no surplus return before taxes. Its after-tax return is 9.83% as opposed to the benchmark of 8.8%. That is 1.03% of the extra return after taxes. A 1.03% tax alpha is equal to a 1.03% post-tax excess return less a 0% pre-tax excess return. The advantages of compounding allow for such disparities, which initially may not seem like much, to mount up over time, especially in accounts with substantial assets and those that are more likely to see short-term capital gains. A tax-aware portfolio may outperform a comparable buy and hold portfolio by a total of 27% over a 25-year period if an ideal tax loss harvesting strategy produces a tax alpha of as high as 1.1% per year. Okay, before we continue, we'd like to ask for a few moments of your time. If you want to support us, please leave a like and click on the subscribe button. This would help us create more engaging content for you. Now moving back to where we left off. Number 4, letting emotions drive decision-making. According to Ford, emotions and investing really shouldn't actually mix because they are just like oil and water. On the other hand, people may see the market plummeting and decide to sell, but that's often unproductive for the long term. For instance, others may see the market skyrocketing and decide to buy at inflated prices because they don't want to miss out at the party. Recognizing your emotions, understanding that they're normal, and then taking steps to reduce or eliminate them will help you avoid the typical investing mistake of making emotional decisions. It might help to simply stop looking at your portfolio. Remind yourself that there will inevitably be peaks and dips in the market, and if you do discover that, you're already erred. For example, by paying a premium for a stock or fund only to see it lose money. Don't berate yourself. Ask yourself, can I learn from this instead of getting angry with myself? When you catch yourself engaging in negative self-talk. Number 5, if you are mixing up risk capacity and risk tolerance, stop now. Recency bias, which occurs when investors place an excessive amount of emphasis on recent market movements or other developments, is another behavioral tendency that manifests in investment decisions. For instance, when times are rough, people may withdraw more money from the market than is prudent, even if they have no immediate need for it. Investors' increased caution may be attributed to their decreased risk appetite, which they may mention. But what really counts for successful investing is how your choices fit with your risk capacity, the amount of risk you can tolerate given your investing time horizon, overall financial status, and available resources. Investors who have several years or perhaps decades until they need the money can take on greater market risk than those who need the money right away. Because they have more time, they may be able to leave their investments alone and potentially recover from substantial market losses. They run the danger of missing some of all the market's rebound as well as the compounded interest for those gains when they act in the opposite direction by cashing out or in any other way attempting to timing the market. On the other hand, savers with urgent financial needs may experience problems if they have an excessive amount of exposure to hazardous assets. To put it another way, problems on both sides of the risk spectrum can be made worse by improperly allocating funds for long and short-term goals. Number 6, do not give everything in just one investment. Variety is supposedly the spice of life. It goes without saying that doing your best and giving your all for your ventures investments shows good character. The reality, however, is different. Instead of putting all your money into one venture, explore. A good portfolio has always been characterized by diversification, which also serves as a means of reducing market volatility stress. What you're attempting to avoid, and what many investors have failed to do, is investing an excessive amount of your capital in a single business or asset. If your portfolio is appropriately diversified, it won't matter as much if one of the assets doesn't perform. In the past, diversification might have meant dividing your investments across stocks and bonds. Brian Ford, head of financial wellness at Truist, says that one of the best ways to diversify is to invest in mutual funds or exchange-traded funds. These funds, which are put together by teams of professionals, remove a lot of the uncertainty involved in choosing equities. By selecting a variety of funds, such as those that concentrate on small or large companies, international stocks, or even certain sectors like energy or consumer goods, you may simply diversify your investments. And last but not the least, for number 7, you're probably paying too much for what you get. Although index funds and ETFs have become very common, there are still certain restrictions on what you can do with them. Such passive funds do not offer investors the chance to outperform the benchmark index, in addition to loss prospects from tax loss harvesting with individual equities. According to Nitin Barve, in this trade-off between cost and control, investors frequently pay for funds that don't always give what they want, including outperformance or the opportunity to tailor holdings to suit their beliefs and values. By bringing a hands-on strategy for potentially creating excess returns when reducing the emotional pull by delegating investment decisions to a professional, actively managed funds can play a complementary role to investor portfolios. The cost of these funds, however, may be higher than that of index funds and ETFs, sometimes by a significant margin. Furthermore, active mutual funds are unable to assist investors in achieving after-tax outperformance since they do not tailor their management of funds to the tax circumstances of each client. The bottom line is that working with a reputable specialist, such as a financial advisor, is a wonderful method to reduce stress when it comes to avoiding investment mistakes. Which of these mistakes could you be making without realizing it? Let us know in the comments below. If you want more content related to this topic, make sure to check out our channel. Take care, and we will see you in the next video.